Good morning and welcome to another edition of our Nedgroup Investments Insights at 10 in the morning. Thanks once again for joining us. I hope you have been enjoying these as we have, getting as much information as we can out to you and making sure that you can have good, meaningful conversations with your clients. I'm really pleased to have on the phone today Julian Campbell-Wood, one of the portfolio managers on our global property fund, dialing all the way from Australia, Sydney in Australia. Thanks for joining us, Julian.
Thanks very much, Rob, and thanks everybody for your interest in taking the time. I'll provide a brief market snapshot, discuss some of the key drivers in the quarter, and then we'll work through the different sector exposures within the portfolio, some of the drivers at this point in time, how we've positioned, and also discuss how we've performed and the outlook for the global real estate sector going forward. So moving first on to slide 3, the market snapshot. It's fair to say this quarter was one of the most challenging and extreme we've seen in an extended period of time. Global equity markets were significantly hit by a number of factors, the most notable being the pandemic, and that brought extreme market volatility as investors and market participants really grappled with the situation, which has been unprecedented in most of our lifetime. And not having a frame to make decisions or to understand the magnitude of the event has led to significant declines in markets as investors try to price and discount the change in operating outlook. The real estate sector was definitely not immune and actually underperformed global equities, and that to a degree reflects the unique impact that the pandemic has on global real estate. Many real estate sectors rely on social mobility and physical visitation to serve their function, and the uncertain duration of this event and how long society may have been in lockdown led investors to really dramatically reprice the sector. It's fair to say certain sectors have been hit harder than others, and I'll step through that as we move through the presentation. From just looking at the regional performance there, Singapore, Hong Kong, the best performing regions, and Hong Kong to a degree was really driven by entering the crisis with somewhat discounted valuations after the recent unrest in that market. If you look at the worst performing regions, the US, where you've had a pretty acute bout of the pandemic, and then through to Australia, for example, where retail property has faced enormous challenges and tends to dominate the Australian index. If you look at the sector level performance, the way that we've split the sectors is really those which are facing the most acute pressure, the vulnerable sectors where visitation is critical to their operation, and that's hotels, retail, and particularly seniors housing. And if you look at the chart on the bottom right there, the sector level performance, you can see that these sectors have endured the most significant repricing and valuation declines. The stay-at-home REITs and those property types which are providing the fabric and function to enable all of us to work remotely and function while we're all in lockdown, residential, data centers and towers, logistics have all performed relatively well. If you move to slide 4, one of the key drivers for the sector over the quarter, and particularly in March when we saw extreme volatility, was the dysfunction in credit markets. And that was not just high yield, investment grade, also treasuries, etc. But those spreads blew out significantly, and those markets did cease to function for a short period. The fiscal and particularly central bank policy to stabilise those markets has been a critical underpinning of the sector and business more broadly, enabling them to roll their debts, admittedly at somewhat higher pricing, as you can see from the charts there in terms of credit spreads blowing out. But the ability to finance these businesses is central to being able to price the equity and central to what has driven a reasonable market recovery in global REITs, but also in broader equities. And functioning credit markets are a central difference to some of the experience that happened in the GFC. So we are seeing REITs able to roll their debts at reasonable pricing, and in that sense, we haven't yet seen material distress in terms of equity raisings at this point in time. What's also important here in terms of leverage and assessing leverage, there's a couple of factors. Firstly, on slide 5, is that the sector entered this crisis positioned in a much better fashion than it did the GFC. The chart there on slide 5 is US REIT leverage as a representative chart. Generally, the global REIT sector has reduced gearing, which does provide it some more flexibility in what is a pretty challenging operating environment. Debt maturities have been extended, and as I said, access to capital is there. What will be tested in this crisis versus others is ICR, and that is also going to be very different by property sector, and you're already seeing that play out in terms of rent collection, which we're getting a real feel for at the moment as we roll through US reporting season. To give you a sense of rent collections across the different property types, at the low end, early indications are malls, retail malls have collected around 15 to 20% of their April rent. Some of the more resilient property types, industrial, logistics, and office at this point in time are at 90 to 95%, so pretty close to historic levels. Residential is in that 85 to 90% range, and strip shopping malls, shopping centres rather, in that sort of 45 to 60% range, and hotels materially below all of that. So that rent collection or lack thereof will put pressure on cash coverage, particularly in those sectors which are facing those challenges. Moving to slide 6, the retail segment. And to frame the discussion on retail, it's important to note that retail is about 6% of the portfolio at the moment, and that is an enormous shift from our perspective, where in the last crisis in the GFC, we had close to 50% of the portfolio in retail property. And that really speaks to the enormous shift in the retail environment, profitability, and the challenges facing some of these malls around the world. We entered this crisis with a very minimal and sizable underweight exposure to retail property, and that has been a big contributor of relative returns for the portfolio. What this event does is really accelerate a lot of the structural changes that were facing retail property around the world. They're most acute in the mall sector, particularly in North America and the UK, where they are a more discretionary focused property. And you are already seeing elevated bankruptcies, valuations falling, and as I touched on, cash collection is pretty challenged. We expect that to continue. This is a sector where many mall companies around the world have suboptimal capital structures as well. They have too much debt. So we do expect in time to see emergency capital raisings. The fall off in footfall in the bottom chart there and the shift to online, we expect to continue. And even after this event, we expect that change to be somewhat sticky and continue to put ongoing pressure on retail property around the world. So we expect to maintain a pretty minimal exposure to retail, and the ones that we do have more focused on the non-discretionary property segment. Slide 7, healthcare. As you would expect in a crisis of this nature, some segments of healthcare are seeing very strong, robust demand. Our exposure in the portfolio is split between medical office buildings, life science and lab space, and very small exposure to hospitals and seniors housing. Medical office and life science being extremely resilient, and the life science space seeing a huge boost in funding to try and be part of the cure for this event. So those are quite resilient property types. We have just over 10% of the portfolio in healthcare and another 4% in life science. So quite a resilient exposure and one of the largest overweight positions in the portfolio. Slide 8, moving to office, a number of different dynamics here. It's around 18% of the portfolio at the moment, but that does include 4% of life science. We did reduce exposure to the office sector during the period, as it is traditionally a more economically sensitive property type, and some of the positions we had did have development exposure. Again, something which we are less comfortable having at this point in time. Office has a number of headwinds. Immediately, it's the reduction in co-working demand and the challenges that these models will be facing. They are a challenged model to begin with. Long-term leases, short-term membership fees, and the social distancing requirements really compound the challenges. They have been a significant absorber of space in many markets around the world. For example, co-working is 6 to 7% of the office footprint in Amsterdam and London. Smaller in some other markets, but WeWork, for example, is a sector tenant in New York. So that demand will evaporate and some of that space will come back on the market, which will provide some challenges for office landlords. That being said, they are experiencing pretty good cash collection compared to other sectors, so aren't as challenged as retail, hotels, etc. The big question for office is that we are all experiencing real-time a work from home experiment, and I think most of the companies that we speak to and individuals are surprised how well it's worked thus far, and that has significant impacts on office property going forward. We would also expect to have a period of lower density within offices while we're working through the issues associated with this virus. So as it stands, somewhat lower exposure in the portfolio, some medium-term questions around demand and indeed the requirements of office space on the other side of this event. Moving to slide 9, logistics. Logistics is currently 17% of the portfolio. It's the second largest overweight position in the portfolio. Very strong demand dynamics in logistics, which have only been accentuated by the current event. The increasing critical nature of supply chains, as we're all working from home and somewhat restricted in our mobility, has been front and center, and you've seen an increase in demand to deal with that as more and more retail shifts online and this delivery infrastructure becomes ever more critical. There will be some fallout in logistics and industrial because there is some economic sensitivity in that property type, but the structural drivers of this are very powerful, and as we move through this event, the further channel shift to e-commerce platforms will continue to increase the demand for last mile logistics. So it's an exposure we're very comfortable with at this point in time. Slide 10, residential. Residential is currently 22% of the portfolio. Again, it's one of our large overweight positions, the largest absolute position in the portfolio. There's a number of different residential exposures in there, from market rate housing in North America in terms of rental apartments, single family homes, again, rental, Germany, where it is much more affordable social type housing, also exposures in Canada and Japan. Residential being very much a basic need, and the rental side of the business tends to be less economically sensitive than some other property types. In North America, the multifamily can be somewhat more volatile than the more defensive exposures we have in Germany. But generally speaking, if anything, this current event compounds the need and the value of one's home, as we're all spending more time there. So very much an exposure which should perform relatively better. It will have some headwinds given the job losses and spike in unemployment in certain markets, and there are movements, whether it's in Berlin, New York, etc., against affordability, but also the restriction on evictions and terminations. So very much a solid exposure to have, but there will be some impact there given the the increase in unemployment we're seeing. Slide 11, data centres and towers. This is our largest sector overweight at about 10% of the portfolio. Again, very powerful structural and cyclical demand drivers for this property type. Everybody working from home, internet traffic volumes have increased significantly, and we are seeing tangible evidence of this, boosting already strong demand for these property types. Very much a less economically sensitive cash flow, and it has performed very well for us over the period. So we have increased exposure to this segment during the event. Moving to slide 12 to outline and frame where we are in terms of valuations and how we're thinking about the outlook. The two charts on the right, our long-term FFO charts based on a universe of stocks we track, which we believe are relatively consistent, shows you that the multiples are now below long-term averages and the NAV discounts are close to 30%. That needs to be considered in the context of these are historic earnings, if you like, and historic NAVs, but it does give you a sense of how the public real estate market has moved relatively quickly to discount the challenges in the operating outlook. Very different to what is obviously happening in the unlisted and direct market. It's fair to say it's a very challenging period to have confidence in your outlook, in your view of recovery. Everybody likes to ascribe a letter, V, U, or L. Ultimately, nobody knows. So what we need to do is focus the portfolio on those segments and property types where you have greater cash flow visibility, maintaining our strong bias towards those companies with lower leverage, which has been an important contributor of our long-term returns, and again will be at this period of time. And again, increasing focus on liquidity, particularly for those property types which are experiencing lower cash rent collections, and what does that mean to the sustainability of their capital structures. We are seeing dividends being cut in some segments and deferred. Interestingly, in the US, companies there do have the ability to pay some of the distribution in stock, and the IRS has provided greater flexibility to do that most recently. So as we get through the end of the year, that may be also the case. At this point in time, we're really only 7 or 8 weeks into this event. We haven't seen a lot of rescue rights issues or equity raises. We have seen some, but they tend to be in the better positioned companies, really just to provide additional flexibility to take advantage of opportunities. Over time, and particularly in segments of retail property where capital structures are suboptimal, we do believe we will see rescue rights issues. So in terms of how we're positioning the portfolio, it's fair to say we're still conservatively positioned. We're focused very much in those segments which have cash flow visibility, providing the functionality as we all work from home, work remotely, shop from home, and we continue to have minimal exposure to those segments, retail, hotel, senior housing, areas where we see the most acute risk. In terms of, on slide 13, in terms of performance, we'd characterise the period as somewhat disappointing from an absolute perspective, reflecting the drawdown. So it's definitely not something we're proud of, but from a relative standpoint, our focus on high quality real estate, the conservative capital structures, and really positioning the portfolio away from those sectors which face the most acute cash flow pressure and challenges has stood us in good stead over the quarter, and we continue to have that focus at this point in time. I'll stop there and happy to open up for any questions.
Thank you very much, Julian. That was a comprehensive rundown of all of the sectors within the global property benchmark. At this point, I'd like to remind everyone that there is a question and answer availability at the bottom of your screen for those using Skype. You just type your question in the box, post it, I'll be able to see it, and I can ask it to Julian. We have had one question come through already, Julian. So first up, How are banks responding to the crisis, and are they restructuring facilities or forcing dividend cuts? So is there any pressure on the REIT businesses from their capital providers?
We've had a number of conversations with management teams over the last few weeks, and the general feedback we get is that banks are being fairly supportive and pragmatic. So you are starting to see covenant waivers come through for some companies around ICR tests in the retail space, particularly Federal Realty as an example there. And many REITs, again, particularly in the challenge sectors of retail, hotels, senior housing, have drawn down on their lines of credit. And there hasn't been any issues or restrictions from the banks there. So for companies with existing facilities, I'd say it's been fairly good thus far. We are hearing that for companies needing new facilities with perhaps banks they don't have a relationship with, that can be a little bit more difficult.
Okay, thank you.
Sorry, it's just on the dividend point. At this stage, no, we haven't seen any or heard of any pressure yet around restricting or lowering dividends as a result of bank financing.
Okay, thank you. The next question's on long-term valuations, and I want to come back to your conversation or your talking points on office. What does this mean? I mean, even within our business, we're thinking about, do we need all the space that we previously had? So is this a longer term impact on the amount of space required within the office sector?
I think there's definitely the possibility for that. In the near term, while we're still grappling with the virus situation, offices won't be able to be occupied anywhere near the same density. Lifting being one major issue, social distancing, etc. So in the short term, our offices, same example, will be operating probably at half density, and the flow on with that is many people will still be working from home. I think as we move forward, people are more accustomed to do it. So perhaps people work 1 to 2 days a week at home, and they do need less office space. So but then it's an offset.
But then they'll still require the space. They'll just need more space between the desks, and so the amount of space businesses still occupy is that likely to change?
But that's the big debate at the moment, and we've been talking to our office landlords as well, and they don't have the answer. They can see the similar effects that we do in the short term, that it's unlikely companies will need less space while we're working through this event, because you'll be operating at such lower densities. I think the medium-term picture is that for many office markets in recent years, you've had increasing densification, so cramming more and more people into less and less space, and that has been a big drag on net absorption. Most landlords we speak to had noted that was starting to ease even before the crisis, and I think this event will definitely put a pause and perhaps send that the other way. But the offset to that is that you may see more and more people working 1 to 2 days or more from home. So it's too early to sort of quantify what that impact is, but it does feel like that this experiment we're all going through is definitely going to provide some greater flexibility in the way that we all work, and that may not be a net positive for office demand.
And you talked about development exposure, and have you removed Derwent from the portfolio? And is that the reason?
We still have a small position in Derwent, and we still do have some small positions in Kilroy, for example, another office developer, and Allied. But we did reduce the exposure significantly. These are well-run companies, and the reason they're in the portfolio is that they have a good long-term track record, and also the markets they're in are the stronger ones. So, for example, Kilroy in the West Coast market, which has been powered by enormous tech demand and supply constraints in San Francisco. Similar dynamic in Toronto for Allied. So high-quality companies, but as you enter a recession of unknown magnitude, it's just an exposure that we prefer to minimise.
And there's a question on residential here. Is it difficult to see any growth in rental income in the companies that you've got a large exposure there, but surely the businesses won't be able to raise rents in this current environment, especially if people haven't been working, unemployment rising. What's the view there?
Yeah, that's definitely right in some markets, and it does depend in the particular market. So in North America, many of the large apartment rental companies have put a moratorium on rent increases, and given the spike in unemployment in North America, you should expect that NOI for these portfolios will decline to a degree. In Germany, it's a different equation because they are much more affordable, significantly more affordable, and many of the tenants have some form of social support or access to, and to a degree, the rent increase for those German portfolios is driven by the companies modernising the space and improving the quality of the apartment. So the rent increase is somewhat of a return on capex. But broadly speaking, you're right, it will be more challenging for most property types. Residential will fare better than a lot of them.
Okay, thanks. And I mean, we're on the performance slide now, and an incredible outperformance of the benchmark and the peer group in the first quarter, which is impacting the 1-3 years now and since inception numbers. So thank you very much for that. But and you talked about some of the drivers in terms of your sector exposure, but are there any individual stocks that have particularly helped the performance during the period?
Yeah, definitely. The largest contributor was a data center company called Equinix. It's a North American network-dense data center company. We've owned it for some time and re-entered the portfolio a couple of quarters ago. Again, very powerful structural dynamics for that company. They have a footprint in Europe and Asia, which are seeing even better growth in demand and data usage than North America, and yeah, as a less economically sensitive cash flow, it's a company that's maintained guidance and will continue to be able to increase earnings. The next on the list I'd call out would be Vonovia. So Vonovia is a German residential landlord. The largest German residential landlord, has a very defensive cash flow, and again, they've maintained guidance. Their portfolio values are actually increasing, and that reflects a significant undersupply in many of their markets, and that the portfolio trades below replacement cost with very affordable rents. The next on the list would be Prologis, which is the largest exposure in the portfolio at close to 9%. And Prologis is a global but principally North American e-commerce and logistics company. And having already reported their results recently, they're still guiding to 8% earnings growth for this year, which in this sort of environment just speaks to the underlying strength in their markets, when many companies are indeed removing guidance given the uncertainty of their business.
Thanks very much, Julian. And then just kind of any final thoughts on the things that you're watching as we come out of the pandemic crisis, and areas that you might be looking to shift the portfolio around based on what you're seeing. Yeah,
I think that's the challenge for us and anyone positioning business at this point in time. It is a very uncertain environment, and this could take a number of turns. We could have a solution in the next 3 months, 6 months, 9 months, 15 months. We just don't know. So what we're trying to do is conservatively position the portfolio where we do have visibility of earnings, and the capital structures can withstand a variety of scenarios, but also looking for tactical value opportunities where some sectors will bounce back after this event. So I'd characterize it as looking for portfolio types which are cyclically but not structurally depressed. An example would be something like student housing, which faces a lot of challenges at the moment, but on the other side of this event should go back to being property type which generates a similar earnings profile. Hotels, you could also put in that bucket, albeit it's going to be a very challenging period until we have a vaccine. So I'd say conservatively positioned, but definitely looking for pockets of deep value where there is those sort of opportunities.
Fantastic. Well, thank you very much for joining us today. I've really got a lot out of this call, so I really appreciate you running us through the entire global REIT universe.
Thanks very much, Rob, and thanks everyone for your time.
And to everyone who joined, thanks very much. I think you'll agree that or concur with me that I think we have the best global REIT manager in the world running our portfolio for us, and I think exposure to this sector, given the extent that it's fallen and some of the factors that Julian mentioned today in terms of the prospects for cash flows from some of these REIT sectors, it is quite enticing. So on that note, I will say tomorrow we have with Ian Beattie from NS Partners on our Global Emerging Market Equity Fund. Again, some really good insights into what's going on around the world in terms of the emerging markets all over the place. So please join us again at 10 tomorrow for that call. Otherwise, I'll leave it there. So thank you very much for joining us and have a great day.